hope everybody had a wonderful day. I know I did. All right, so welcome to the first webinar of the True Gold Trading series. Today we're gonna cover Forex basics, so we're not looking at any charts for the day. And I mean Forex basics as far as what is Forex, what is trading in Forex, who trades it, and pretty much basic Forex terminology and order types and such. All right, so make sure you have your paper, pen, pencil, notebook ready because you should take notes. This is very, very valuable information, or you could just review the video as many times as you want. It will be recorded. Actually, it is being recorded. All right, so Forex basics. Number one, what is Forex? Forex is short for foreign exchange. Forex, foreign exchange, right? And it is simply the exchange of one currency for another. Therefore, what do you think the Forex market is? It is the market that allows the exchange of one currency to another. It is also the largest financial market in the world. So if you take a look at the illustration to the right, you can see that this is a little tiny guy. This is the stock market right here. If you thought that the New York Stock Exchange or Wall Street was big, this is them right here. This is it right here, right? Compared to the Forex market, which is this huge monster right here, right? It is a $6.6 trillion a day market as of 2020, and $1.9 trillion a day comes from us. People like you and me, the retail traders, right? It's a lot of money. It's a lot of money to be made. $6.6 trillion, there's money for everybody. All right. Next, what is traded in Forex? Money. However, you're not buying or selling anything physically. Think of buying a currency as buying a share in a specific country, right? So for example, let's say you're buying the Japanese yen. You're basically buying a share in the Japanese economy, okay? Now, not literally, but this is how I want you to think of it, all right? Just for now. Now, the price of a currency is a reflection of a country's current and future economic health. All right, so who trades Forex? If you take a look at the illustration in front of you, you can see that all the way at the top of the food chain, we have major banks. These guys are the super banks, aka inner banks, or the market makers. Now, they are the largest banks in the world, which is why they are called market makers, right? They determine the exchange rates. So to give you a few examples, you have UBS, Barclays Capital, Deutsche Bank, and Citigroup, so on and so forth. Next, you have number two, large commercial companies, or you can say medium-sized and small banks. Really, it's medium-sized and small banks, right? And then you have hedge funds and commercial companies, governments, so on and so forth. And then lastly, you have us, the retail trader. We're called speculators, retail traders. Yeah. So when you take a look at the foreign exchange, you're gonna notice, you need to know that you're never buying or selling just one currency pair. You're never doing that. It's like I can't be like, look, I'm gonna sell you this water. I'm gonna sell you this water for nothing. So I'm not selling it to you, I'm giving it to you, right? So when it comes to Forex, you're never trading one thing for the other. It's like I have this water bottle, you have an apple juice, and I say, here, I'll give you, I'm gonna sell you this. I'm buying your apple juice with my water bottle, right? So I'm selling the water bottle, I'm buying the juice. Same thing. That's how Forex works. You have Euro USD, so you always have pairs. It is one currency against the other currency. one currency against the other currency, not, oh, let me buy the US dollar, or let me sell the Mexican peso. Nah, it don't work that way. Because at the end of the day, what are you gonna, if you're gonna buy the Mexican peso, what are you buying it with? You're gonna buy it with Dominican peso, you're gonna buy it with US dollars, what are you buying it with? You get what I'm saying? It's always a trade, one for another. Alright, so with that being said, you have major currency pairs, minor currency pairs, and exotic currency pairs. Exotic currency pairs being, you have major currencies, minor currencies, and exotic currencies, right? Exotic currencies being from like Mexico, Dominican Republic, I don't know, Africa, things like that. And then you have, remember, it's traded in pairs though, so now you have a different category, right? Which is major currency pairs, minor currency pairs, cross pairs, and exotic pairs, right? This is all in the Forex market. Now, if you take a look at this illustration, you can see it says major currencies. I'm not gonna go over all the currencies, right? But these are the major currencies, right? So, currencies. Currency symbols always have three letters, where the first two letters identify the name of the country, and the third letter identifies the name of the country's currency. So, for example, USD would be United U States S Dollar D, USD. That's the symbol, right? Another one, GBP, Great Britain Pound. Switzerland, CHF is a little weird, but just go with it. Switzerland franc. CAD would be Canadian dollar. AUD would be Australian dollar. NZD would be New Zealand dollar. Notice how some of them, they're not two-word letter country or two-letter country, but when that happens, they usually use two letters from the first word, and then the third letter would be from the country's currency. So you have now going to the type of pairs, right? You have major currency pairs, minor currency pairs, and exotic pairs, right? And cross pairs. So major currency pairs all contain the US dollar on one side and another major currency on the other side. They are the most frequently traded pairs in the Forex market. What do I mean by that? Take a look at this. If you have the euro with the JPY, that is not a major currency pair. Why? Because it does not have the US dollar. The US dollar is the most used currency in the world. It is, they say, the most important, I guess. I don't know. Anyways, it does take a big space in the foreign exchange. All right. So the majority of the money from the forex market is US dollars. All right. Which is why if the US dollar is not in it, it is not a major currency pair. It does not matter if it is a major with another major. All right. So that would move us on to cross pairs. Cross pairs are pairs from major currencies paired with another major currency, but no US dollar. So for example, Euro with JPY or Euro with GBP, Euro CHF, JPY CAD, GBP CHF, GBP AUD, NZD CHF, all these would be cross currency, right? Because it is a major with another major, not containing the US dollar on any side. Then you go to minor currencies, which would be a minor with another minor or a minor with a major. And then you finally have exotic pairs, which would be US dollar. So an exotic pair would be, they're made up of a major currency paired with the currency of an emerging or strong but smaller economy from a global perspective, such as Hong Kong, Singapore, Turkey, Mexico, or even South Africa. So what do I mean by that? Take a look right here. It could be Great Britain pound with the Mexican peso. It could be US dollar with Dominican peso. Any of these are exotic currency pairs. They are very volatile, by the way. Alright, so major currency pairs. Real quick, these pairs all contain, I'll just explain this real quick again, or read it one more time because I already explained it. These pairs all contain the US dollar on one side and are the most frequently traded pairs in the world, right? They are the most liquid and widely traded currency pairs in the world. Alright, so Forex quotes. Forex quotes is a good one. Remember that I told you that you are trading one against the other, right? So this is what it looks like. This is what a Forex quote would look like. You are doing one against the other at the exchange price, right? So this is how it works. When you open up the application on your phone, right? When you open up the application on your phone and you have two buttons. You have two buttons. It says sell and buy. Okay, whatever. But it says sell and buy. The blue is buy, the red is sell, right? This is what it means. The base currency, right? You have the first currency and you have the second currency, right? So the first currency is the base currency. The second currency is the quote currency. What does this mean? The base currency is the basis for the buy or the sell. So when you click buy, that's why you're buying the base currency, right? When you click sell, that's why you're selling the base currency. However, simultaneously, you're doing the opposite to the other currency. What do I mean by that? Do I have a pen? Yes, I do. What do I mean by that? If you click buy on your phone, you're buying this. At the same time, you are selling this. Remember what I told you? You are trading. I sell you this, I'm buying your juice. I'm selling my water to buy your juice. That's how it works. So what happens if you click sell on your phone? What happens then? This is what happens. If you click sell on your phone, right, on GBP, since it is the base currency, that means that you're now selling the pound, right? At the same time, you are buying the dollar. And this is how it works. Simultaneously, you don't see it happening, but this is just what's going on. The broker automatically does that for you. It is happening, behind the scenes. Behind the scenes. You don't see it happening. But just know that that's how it works. Alright, so if you buy GBP USD, this simply means that you are buying the base currency, GBP, while simultaneously selling the currency, USD, and vice versa. Alright, so understanding Forex quotes and terms. First, you have buy and you have sell, right? But for buy and sell, you have different words to go about it, right? So for example, buy would be long and sell would be short. Now, the easy way to remember this is you only need to remember one, because obviously if one is one, the other one is the opposite. I mean, it's just common sense. You only need to remember one from out of two, right? If it was three, it'd be different. But out of two, you only need to remember one, right? So the easy way to remember is this. Think of short sell. When you think of short sell, you already know that short is a sell, right? So what is the opposite? Buy equals long. Buy is long. Then there is animal terms. So if you ever been to Wall Street, there's a big bull, a statue, right? That represents something. That represents the buyers. So the bulls are the buyers and the bears are the sellers. All right. There's another way to put it, or not another way to put it, but different wording that you could use, right? Out of bears and sellers. So for example, if I tell you buy, long, bull, right? Bull or bullish market. It's a bullish market. That means it's an also uptrending market, right? So now you got buy, long, bull, bullish, uptrend, up. It all means the same thing. It is going up, right? And then you have sell, short, bear or bears. Then you have bearish. Oh, it's a bearish market. It is a downtrending market, right? Downtrending as in down. 6 words. It is all the same thing, right? It is all the same thing. Next, also, the way I like to remember this or teach people to remember it is by looking at the first two letters, like a baby, BESE, BU, BU. You get what I'm saying? Bet, set, bu, bu, like a baby. Anyway, so moving forward, you have bid and ask price. What is a bid and ask price? The bid price is the market, is the price that the market is willing to pay, right? To pay you. So that's the price you're selling it for, right? So I'm the broker. This is your phone, and I say, hey, you know what? You want to sell this iPhone, but I'm gonna give you. You want to sell this iPhone for $10? But I'm gonna give you 8. So I'm buying it for 8. That's the bid price. The ask price is the market, is the price that the market is asking for you to pay. So I have this iPhone, I'm the market, and you want to buy the iPhone, and I tell you, you know what, this iPhone is worth $10, but I gotta make a profit. So give me 11. Give me 11. That's the ask price, because that's the price that I'm asking for. The bid is the price that you gotta pay, or sorry, that I gotta pay. Ask is what I'm asking for. The broker. So finally, you have spread. A spread, it is just the price difference between the bid and the ask price. So if I bought this at $5, if I have the bid at $6, but I'm buying it for $4, that's a price difference of $2. So that's the spread. Rollover, aka swap, it is an interest fee charged for leaving your trade open overnight. So meaning from one trading day to the next, it would be, let's say 11:59 a.m. to 11:59 p.m. Boom, 12 a.m. That's a new trading day. Except that for us, this webinar is currently being recorded on New York Eastern Time. So for us, it would be around 4 p.m. Eastern Time, right? So if you have your trade open, even if you opened it literally at 3:59 and you left it open 4 o'clock, boom, you're paying that fee. It is not a big deal. You won't even feel it, but just know when you see that fee, that's what it is. All right. So, what is a pip? A pip is the unit of measurement to express change in value between two currencies. All right. So the pip is not measured in cents. Sorry, the market or currencies are not measured in cents. Right? They are measured in pips. So that is the unit of measurement. If Euro USD moves from 1.2250 to 1.2251. It was a 0.0001 rise in value. That is one move up. That is one pip, right? A pip is usually the last decimal place of a quotation. It is the last decimal place of a quotation, right? Most pairs go out to 4 decimal places, but there are some exceptions like the Japanese yen. They go out to 2 decimal places, all right? So now I want you to retain that information, write it down real quick, and then forget about it, right? Because nowadays we have pipettes or pipette, right? I don't really like that word. I rather use fraction of pip or my favorite word, micro pip, right? Now, where does micro pips come from? There are brokers that quote currency pairs beyond the 4 and 2, right? So instead of using 4 and 2, they're actually breaking it down even more. Now they're adding another 10th, right? So instead of 4 and 2, they're using 5 and 3 decimal places. In those cases, or I like to say in most cases, because nowadays, the reason why I said forget about pips is because nowadays, most brokers that I've seen, they're breaking it down to the micro pip. So you're not gonna have that confusion. Oh, is it 4 or 5? You get what I'm saying? But it's still good to know. Now, in those cases, right, where they're using, or in most cases where they're using micro pips, right, the last number would be the micro pip. The second to last number would be the pip, right? So if this is the pip, 1.2250, the 0 is the pip, and then they add another 0. Now this is still the pip, and now the extra 0 would be the micro pip, right? Now remember this, there is 10 micro pips in each pip. So if the last 0 goes up 10, what do you think this second to last 0 is going to do? It's going to go up to 1, right? That means it went up 1 pip, or it went up 10 micro pips. All right, so another example. For instance, if GBP USD moves from 1.51542 to 1.51543, that 0.00001 move higher is 1 micro pip. Coolio. So what is a lot size? A lot size is the amount that you are trading on the Forex market on any particular position. So we broke it down between 3 types. We have a micro lot, would be anywhere from 1 cent to 9 cents. We have a mini lot, would be anywhere from 10 cents to 99 cents. And we have a standard lot, would be range anywhere from $1 and beyond. All right, so to calculate profits and loss, simply multiply your lot size times the micro pips gained or lost, micro pips, minus the spread times the lot size. Now, since there is 10 pips, 10 micro pips in each pip, another way you could do it is multiplying your lot size times pips gained or lost, right? And then just multiply times 10. Same thing. And then you just subtract the spread times the lot size. The spread times the lot size. Excuse me. Sorry about that. I'm shutting this phone off. Oops. Anyways, so you don't really have to just know this information, right? But it's not like you're gonna really use it, because everything, like it says right here, everything is done for you on the MT4 app, the MetaTrader 4 app. And if you actually own a Windows, and you have the MetaTrader 4 on your Windows computer or laptop, all you got to do is set your stop loss or your take profit. Just hover your mouse over it, and it'll show the potential loss or gain. So you don't need to worry about calculating or anything. But it is still good to know how it is done. All right. So we're almost done here. All right, so Forex order types. You have two types of order types, right? You have number one, what would be called a market execution, and you have number two. Now, number two, you can break it down between a limit or a stop order, right? That's when you break it down. So, a market execution would be you grabbing your phone or your computer and you click buy or sell. So, it is basically buying or selling at the best available price. When you click that sell button or buy button, boom, and that position opens, that was a market execution. So that was a market execution order or market order. There's different names for it, however you feel comfortable. Next, you have pending orders, right? Pending orders, you can break it down between limit orders and stop orders, right? So limit orders would be used for reversals, and now you could break that down into buy limit or a sell limit. So is it a reversal for a sell or a reversal for a buy? What do I mean by that? This is, take a look at this iPhone. Take a look at this iPhone, right? This iPhone is worth $10. Boom, 10. If this iPhone, you're looking at this market and you say, you know what? The market is gonna go down to 5 and then go up. So you're gonna place your buy limit, right? Because it is for reversal, right? So you're gonna place a buy limit at $5 when the price of the iPhone starts dropping and reaches 5. It'll place a buy for you automatically, hands free. You don't have to do anything, right? So now you're in a buy and the market starts going up and you're in profit automatically, right? So it is used for reversals. The same thing if it was worth $3 and you say, hey, you know what? It's gonna go up to $5 and then it's gonna drop. So you're gonna use a sell limit, right? Now fast forward, you have stop orders, right? Stop orders, you can also break it down between a buy stop and a sell stop, and it is used for continuations, right? What do I mean by that? Continuations. Get the pen real quick. You got the same iPhone. The iPhone is worth $3. Boom. And you say, hey, you know what? I think that if the iPhone hits $5, most likely it's gonna continue going up. So I'm gonna buy at $5. But it's gotta hit 5 because if not, you're not sure. So you place a buy stop, right? Because it is used for continuations. You place a buy stop at $5. Whoops. Place a buy stop at $5. Now what happens? When the market starts going up, it reaches $5, it'll automatically open a trade for a buy for you, right? Now you're in profit when the market continues to go up. Same thing with a sell. If the iPhone is worth $7, you say, hey, it's gonna come down to 5 and keep on dropping. So you place your sell stop for continuation. Sell stop for continuation at the $5. Market starts dropping. Once it reaches your $4, it's gonna place that sell for you, and you are now in profit. All right. A stop loss and take profit would be easy out. So hands free. Let's say that this iPhone is $5 and you say you have your stop loss at $3 and you have your take profit at $10. So what happens? It's $5 right now. It hits 6, 7, 8, 9, 10. Boom. Once it hits 10, it'll take profit for you automatically, close the trade, and secure your profits. You are no longer in your trade. Hands free. So you could have been sleeping, eating, flying, I don't know, singing in the shower, whatever you want, you know. However, if the market went against you and the price of the iPhone started dropping, so and it hit $3, boom, it'll hit your stop loss and it'll close out your trade. That way you're not gonna lose any more money than you are willing to lose. The trailing stop is a fancy way to use the stop loss. It's like you're having you playing a game with your son, with your child, right? And you tell them, hey, you gotta stay 5 steps behind me as long as I move forward. All right. So when I say go, 1, 2, 3, you take the 3 steps. He can't move because you gotta stay 5 steps behind you. He can't move. Once you hit that 5th step, he still can't move. Once you hit that 6th step, boom, he gotta move up 1 and stay as close. 5 steps behind you always. Boom. As long as you're moving forward. So if you go back, now you're at 6, right? If you go back 2, you would be at 4. Your kid would be at 1, right? Because he's not moving. Then you start moving. Boom. Once you hit 7, he goes to 2. Once you hit 8, he goes to 3. He's always staying 5 steps behind you as long as you're moving forward, right? This is a nice way to continually secure more profits as you go, right? So you can set the distance however long you want. You can put 1 pip, 10 pip, 500 pips, whatever it is that you're comfortable with. All right, so Forex trading sessions. There are 4 main trading sessions in the Forex market. 1 being the Sydney, 2 being the Tokyo, London session, and the New York session, right? So when 2 sessions are open at the same time, this is called an overlap, right? For example, Sydney and Tokyo are both open at the same time from 7 p.m. to 3 in the morning, right? They both open at 7 p.m., right? Because this was already open. This opens, this was already open. It was already open. So now they're both open. Now they're both open. Boom, 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 boom. This one closes at 3. This one closes at 3. They're no longer open. Well, both of them at the same time, right? This one still got 1 more hour left. Same thing with the London and New York, right? From 8 in the morning to 12 p.m. because this one is already open. This one was already open at 8 and it closes at 12. So from 8 a.m. to 12 p.m. you have the London and New York session overlap. During this overlap, there is more volatility due to more people trading at the same time. So the best times to trade Forex would be the Tokyo and the London overlap, also the New York and the London overlap. So anywhere between 8 a.m. to 12 p.m. or 9 to 12. So best days to trade Forex would be typically the middle of the week. You can see that the pip range widens for most currency pairs. However, Monday and Friday is also good. But best days, middle of the week, right? So what do you think are the worst days? The worst days would be Sunday, right? Everyone is relaxing or enjoying the weekend. The market just open. There's a lot of fake outs, right? Fridays, liquidity dies down during the later part of the US. So like past 11 p.m. on Friday, 11, 12 p.m., you don't want to be trading no more. 11 a.m., 12 p.m. You don't want to be trading no more. Also, holidays, especially national holidays, everyone takes a break. The banks are closed. Government's closed. There's no transactions going on. There's no one participating in the Forex market. And the banks take up or create most of the volume. Most of the liquidity for the market to move comes from the big banks. All right, when they're closed, there's nothing going on. Anyway, so major news event. You don't want to get whipsawed. You're gonna learn about news later on. And finally, some events, American Idol, the NBA Finals, Super Bowl, no liquidity, everyone's watching the show. Take a seat, enjoy the show, come back another day. All right. So, best times review real quick when 2 sessions are overlapping. Right, these are also times major news events come out to potentially spark some volatility and directional movements. The European session tends to be the busiest out of the three, and the middle of the week typically shows the most movement as the pip range widens for most currency pairs. So, as a Forex trader, what are we doing? We capitalize, right? We are capitalizing from the Forex market by controlling. What do I mean by controlling? What does controlling mean? Simultaneously buying and selling. So you're buying and selling, buying and selling, buying and selling. Boom, 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 buying and selling, right? So we're capitalizing from the Forex market by controlling simultaneously buying and selling large amounts of currencies with minimum capital. How? By using leverage from your broker. If you don't quite understand, I'll explain some more right now, right? What does leverage means? You're using leverage from your broker. Leverage involves borrowing a certain amount of money needed to invest in something. In the case of Forex, that money is usually borrowed from a broker. Forex trading does offer high leverage in the sense that for a small margin or for an initial margin requirement, a trader can build up and control huge amounts of money. Still don't understand? You're wondering how much money? I'm gonna tell you right now. Let's just say that different brokers offer different amount of leverages. They range from 1 to 1 all the way to 1 to 1,000 and even higher. It is ridiculous. Brokers are literally telling you, "I'll give you 1,000 times what you have if you show me your ID." That's all they're saying. Once again, about how much money? Let's just say that different brokers offer different amount of leverage, anywhere from 1 to 1,000, right? So with a leverage of 1 to 500, every dollar in your margin account controls $500 worth of trading. So if you have or if you got $100, each dollar is gonna control 500. Each dollar. So 500 times 100, that's about 5,000 or 50,000. I'm not even sure. All right, another example, $1,000, right? And using a 1 to 1,000 leverage, you can potentially control $1 million worth of currency. How? 1 million times 1 million per million. 1,000 times 1,000. You're controlling $1,000 with each dollar, and you got $1,000. So this is how you are able to prove profit or lose so much with such small moves, right? What are moves? Price change in the market, right? Remember that the market moves in terms of pips. Pips are not cents; they are less than cents. Excuse my voice, I'm getting dried out already. My throat hurts. So they are less than cents, right? They are not cents. So you can potentially make or lose thousands of dollars with a small price change, as small as half a cent, right? Depending on your leverage, margin, and lot size. All right, so this is the end, guys. I hope this was good information for y'all. That it was very, very valuable. And yeah, man, thanks for watching. Thanks for supporting. Make sure to click the like button, subscribe, and I'll be uploading the next webinars. I'll see you on the next one. All right. Stay blessed.